tonight. First off, I'd like to introduce myself. I'm Amanda Skabowski, and I'm the Vice President of Networking for the PACE Board of Directors, and it was my committee's job to be in charge of this. The co-chair for this event are Megan Posey and Katie McCollin, who's somewhere floating around. But I just wanted to thank you guys for coming. We're really excited about this turnout, and hopefully it's helpful for you guys. Our first speaker is Stephanie Hamge, and she's from PEFQ. So if you could give her a round of applause, we'll get started.
Hey, it's great to be here. Who is, I know we have a variety of people tonight, some juniors, some seniors, some grads. Who's graduating? Okay, the majority of you. Okay, great. A few juniors here? Just friends, supportive friends? Okay, interested in finances? Okay, great. Please feel free to stop me at any point, ask some questions. Really would rather have this be interactive than just me talking and then you waiting for answering questions at the end. So just raise your hand, just yell out my name, whatever you want to say, because I just want to help you in any questions you might have, and this is a great chance for you. So let's get started. Okay, so you're graduating. Now what? Kind of exciting, kind of scary all at the same time, I suppose. Who has a job offer yet? Yay! Going away? Moving somewhere else? Shout out where you're going.
Chicago.
Chicago. DC, Chicago, St. Louis, great. Not too far away. All right, good, good, good. So the rest of you still interviewing? Looking for jobs? Who's going to grad school? All right, last couple years there were a lot of people going to grad school at this point because the job prospects weren't so great, so that's encouraging. So that new job, your new horizon, going to bring you some new expenses to go along with it. So maybe some new clothes for your job, a new car you might need, you need some housing, you have some extra expenses, how are you going to do for it, and how are you going to get there. And that credit score that you do or don't have at this point is going to be helpful to you along your way when you get going on your road and help you know what you can afford. Who knows their credit score? You don't have to say what it is, just do you know what it is? Okay, does everybody know they have or should have a credit score? You have a credit file. It's being tracked on how you pay your bills on time, your last known and your previous address. Just gives a lender some information, a snapshot about how you have conducted your financial life. If you weren't aware of that, it's your last known employer. It'll tell us your monthly debts, your payment history, meaning do you pay your bills on time? And on time is you have a due date for a bill, and then there's this 30-day period, a 60-day period, a 90-day period or more after when the bill was due, meaning did you pay your bill on time? So as a lender, we look at how many times have you been 30 days past due? Have you been 60 days past due? How about 90 days past due? Do you have a charge-off haunting you from something you didn't pay? You can't ignore it, it won't go away, it's still going to be there in your credit file, but you can take care of it, clean it up, pay it off, and it vastly improves your credit file. You can annually get a free credit report from each of the credit agencies, and they're free. You should not have to pay for them. When you go out and you do that, be careful that you're not accidentally not checking a box that's already pre-populated for you saying, yes, I would like to have monthly credit monitoring and getting my credit score every month and alerts, and it'll only cost me $10 a month. You really don't need those kind of things, but you could pull up your credit report and look at that for free, and you should do that. You should know what's on there. Your credit report is also going to have your credit balances and your available limits. So if you have a credit card that has a $2,000 credit line and you have a $500 balance, that's a good ratio. If you have a $2,000 credit card and you have a $2,000 balance or nearly $2,000 balance, that's not a good ratio. As a lender, we look at that like, ooh, they're using most of their line, you know, do they need this? Whereas you might be thinking, I only want a $2,000 balance. I never want to have more debt than that. Your intentions were good, but maybe that wasn't the best situation for you. So annualcreditreport.com, I think you have a copy of my slides, so you can go to that link and get a copy of your credit report. So what makes up your score? It's a mystery. It's a mystery for lenders on how these scores are made up, but this is the best scenario that the credit reporting agencies can give to us on really how they come up with this. 30% is the amount you owe, and that's again based on how much you're using. If you have that $2,000 credit line, how much of it are you using? Okay, so how much do you owe? Your payment history. Are you paying those bills on time? So when you pull up your credit report, you'll see a line for maybe a Gap card or a credit card. It's not going to have your checking account. It's going to have your auto loan if you have one. It's not going to have your apartment rent. It's going to show a charge off if you didn't pay your cell phone bill. But it's going to show all those lines of things that you monthly pay bills and loans to. And then over to the side, there's these hash marks of how many times you've paid 30 days late, 60 days late, 90 days late. And those are the things that we're going to look at as a lender. The types of credit that you use as far as unsecured debt, meaning a credit card, something that's not secured by a item of value, such as a car or a house or a motorcycle. The length of time in a credit history. As a young adult, how many people have a credit card? And a car loan or a car loan? Okay. So for those of you who've raised your hand, you have a credit history. If you have student loans, they're on your credit history, but if you are not making payments on those at this time, as a lender, we kind of look at those. That's not really a credit score. It's in your file. It's maybe been there a few years, but since you aren't in repayment for that, we would not consider that a valid credit score yet. So your length of history. So when you, for any of you who maybe have a credit card you opened maybe in the last year or two, that's a pretty new file. That's young history. Your piece of history that you've held the longest can be a weight factor for you. So you would not want to close something that you've recently opened a year or so ago. That's really going to help you establish that. So keep that piece you've had the longest as you go through your financial life, and hopefully you can keep growing on that if it's a product that still makes sense for you. And then 10% is your new credit. So resist the urge to go out and open a whole bunch of new credit all at once. As a lender, if we pull your credit report and we see, wow, they've applied for 5 car loans this month and 4 credit cards, and to us that might indicate accelerating debt. So do it carefully as you go through that. Any questions? Okay. Okay. This one is, why do I need good credit? Well, you need good credit now and for the rest of your life. It really does help you move along, helps you save money on other things as you go forward. Get a new car. Anybody going to be buying a new car or a used car? That credit score you have is going to determine maybe the interest rate that you're going to get. It can determine whether you're going to get the loan at all. You might just not get the loan based on your credit score. Landlords, they might look at your credit score to lease an apartment for you. Your credit history and your payment history indicate what type of individual are you. Are you responsible with your finances? Are they someone that they can trust that you are going to make their payments to them? Maybe you could get your utilities at your new place without a deposit if you have a good credit score. And employers, they regularly check for your credit score. For those of you who have a job, do you know, did your future employer check your credit? It probably was somewhere in the materials where you signed off and you applied for the job, you know, that they were going to check your history. Some employers won't hire you if you have a low credit score. And opening a checking account as a financial institution, we have a process to go through on how we're going to open a checking account. If you have a credit file and there's nothing in it, that's great. But if you have a credit file and you have a derogatory credit, then that for us, that's like, I'm not sure that you're a checking risk that we would want to take. So keep your good credit score. And then also for insurance. Insurance, which I would not be the expert, that would be Liberty Mutual. From what little I know as a homeowner and a person with cars and teenagers, it's not just about whether I made any claims or not. It's about other ratios that go into an account, and it's kind of complicated, I guess. And so your credit score is a piece of that. It kind of paints that picture of who are you and how do you maintain your life, and are you a good insurance risk for an insurance company. But I bet you might talk more about that. All right. So where does your money go? I see that some of you submitted some questions that you'd like me to answer, and some of it has to do with budgeting, and so kind of scary. Yeah.
I just had a question back on the credit card.
Okay.
Credit score. If I don't have a credit card yet, my dad and I was playing with the idea of needing a credit card now, because I think Discover is kind of easy to get before you have a job. Should I try and do that now to help build up good credit, or should I just wait till I get a job and get one that's a little easier?
Okay, so you've been talking to your dad about getting a credit card. I would suggest there's lots of opportunities to get credit cards. Maybe going with the place that it's easiest to get isn't always the best thing for you. So research what is a good credit card. There's a website called the creditcardconnection.org, and it's a place to help consumers find fair and ethical credit cards. So that's a site you can go to. They have what's called a dean's list and a detention list. I think Discover might be on the detention list, so you can go and look for that. But yes, I would, get a credit card if you can. You can get what's called a secured credit card, and a secured credit card means it's secured by funds you have in an account. So you might have $500 in a savings account, and then that equals a $500 credit card for you. You can't take that money out of the savings account, but you can have this $500 credit card, and it'll have a $500 line, and you can make purchases and make payments on that $500 line. And at some point, if you think, I don't want this anymore, I want to close it, you get your $500 back that's in the savings account. But ideally, the point of it is to help you build a credit history and to build a financial security with it, and at some point when you're stronger to be able to say, I no longer need that type of product. I would just like an open credit line. I'd like my $500 to be available to me, and I would like a larger line. So I would suggest yes. Some parents like to be a co-signer on a credit card with their child, and that can be great in some ways, and that can also have some disadvantages to it. Because when you open and even as an authorized user, if your parent has a card and they want to put you as an authorized user to help you grow credit, as a lender, we still don't view that as that was your credit. We view that as you were on your dad's credit card. He most likely was paying the bills. So your dad paid the bills that you got the benefit of, and it did help you build a score, but we don't necessarily as a lender see that as that was your score. So you could also open a joint account, which is good and has its disadvantages, because at some point if either one of you went off the card, you might have to close the card. That puts you back to square one, reestablishing a credit history file. So if you can start it on your own, that's the ideal situation. So if you can't get it on your own, and maybe you want to do that the secure piece of it, you could do that. It's kind of like a prepaid card, but a prepaid card is just like advancing on a gift card. And that does not go towards a credit score either. So a secured card does, a prepaid card does not. Prepaid cards are pretty popular right now. I would say in the payment world, that's probably one of the most popular pieces, because with the economy a few years ago that wasn't so great, most consumers really stepped back from credit cards and thought debit cards were the greatest. And debit cards are great for those everyday expenses, but credit cards give you some protection that debit cards don't. But debit cards don't help you build a credit score either. Okay, they're not going to help you get going on the things that you need to do for your life. Yes.
So I have a debit card.
Yes.
I've been thinking about opening up a credit card.
Okay.
I mean, obviously there's the advantage of the credit card that you build your credit history, but is there an advantage of having a debit card versus a credit card?
Okay, so you have a debit card, you're thinking about getting a credit card, and are there advantages of a debit card not on a credit card? Is that right? The advantage, a debit card, it pulls funds from a checking account, and debit cards are great. Debit cards are great for buying your everyday things that you need, and it takes the replacement of writing a check. I was on vacation last week and at a store in Hilton Head, and there was a long line, and we're all standing there waiting to pay, and the line just kind of stopped. I'm like, what the heck's going on? The lady in the very front of the line was writing a check, and the girl who was working, she said, what is that? And she was younger. She's probably your age. She's like, what is that? She had to go get a manager. She's like, I don't know what she wants to do. She wants to pay by a piece of paper, which we're like, oh my gosh, taking forever, and just stopped. So debit card really is just instead of doing that check. There are places you don't want to use a debit card for your protection. You don't want to use it for an online purchase. You don't want to use it to secure a hotel room. Rental car agencies won't take it because they are funds that aren't guaranteed in a sense. But what hotels will do if you use a debit card, they will put a hold on your funds, and not necessarily for the cost of the room for that night or the 2 nights or whatever you have, but additional, and they'll hold it longer than maybe when after you checked out. So that's your cash that you won't have access to. Because they've got this hold on it. Or if you have a debit card with a financial institution that allows you to overdraw your account, they kind of promote it as a courtesy, then you could unbeknowingly to yourself be overdrawing your account because you think you've got cash, not knowing this hotel has this big hold on your account, and you're going to be overdrawing, and you're going to have overdraft fees. So there are places you don't want to use a debit card, and again, a debit card doesn't help you grow a credit score. So debit cards kind of act like credit cards. They look the same. You swipe them, it seems to be the same. You write a check, or excuse me, you sign your name on the slip, but you're not getting the benefit from it, and then there's not the protection. So credit cards, there are times that if you're making an online purchase, you would never want to use your credit card, because if there was fraud on something, you're always going to be protected by MasterCard or Visa, whoever issues the card. You're always going to have that protection if there's fraud on your account. But in the meantime, if someone's wiped out your checking account through fraud because you did it for an online purchase, or someone got your number and looked at it from somewhere else, they've taken your cash, they've taken your money that you need to live on, and maybe you've written a check for your rent payment or your car payment, and you're going to be bouncing those. It takes a few days to go through the Visa dispute process or the MasterCard dispute process to get your money back. You do get it. So there's just, there's some places you really don't want to use a debit card, and credit cards offer some protections that debit cards don't for you too. Does that answer your question?
Yes.
Okay. Yes.
Why do some credit cards have monthly fees, and some, like, are those?
A monthly fee or an annual fee? Sure. The question was, why does a credit card have a monthly fee? Some do. That'd be a bad credit card. Yeah. There are hundreds and hundreds of credit cards that you can get. You should always be able to get a credit card without an annual fee, certainly without a monthly fee. Any credit card that promotes is going to help you reestablish credit, rehabilitate your credit, help you build credit, and you just have to pay this fee is not the card for you. You should never do that. There are cards that offer rewards and perks, and those come sometimes with fees. Not always, but really, does the reward outweigh the fee that you're paying? Probably not. Not for the point of your life that you're in right now. Any other questions? Okay, great. So tracking your expenses. So for those of you who have jobs, and for those of you still looking for jobs, the potential of all of a sudden having, it seems like tons and tons of money, can be a little overwhelming, and you can, maybe make a mistake in the beginning that you're going to want to fix right away too. So there are lots of places that you can do some budgeting software. The first thing you need to know is what are wants and needs, and truly what are wants and needs. I have a 16-year-old who thinks she needs an iPhone. I'm like, no, you don't need an iPhone. You have a cell phone. It does what it needs to do. You can call me. You can text me. I don't even think you need that, actually, but she's got that. She thinks she needs an iPhone. She wants an iPhone. So really establishing what your needs and wants are, and your patterns in spending. So you have to start tracking your money. I would suggest doing that now. Getting in the habit of tracking your money now. How much money did you spend today? Are you really aware of every time you swiped your card, if you use a debit card for that $2 purchase for a drink or something at McDonald's, or a purchase it for a magazine, or whatever you spent your money on today, do you really know how much money you spent today? And so really tracking that. There's lots of methods to do that. Categorizing your spending between clothing, food, really creating a budget for yourself, and identifying future spending also. Lots of places you can do this at. Lots of easy places. PurdueFed.com, we have Money Coach. That's on our website. You can go straight there. There's cashcourse.org at Purdue. That's been available to you the entire time you were a student. It's on Purdue's website. So hopefully some of you knew that. What's my score? Can I click through these? Is it internet? Are these hyperlinks that I can get to? Let's go to the Purdue link. So this is the intro page, and you can see there's budgeting and financial planning, overspending, banking with your money, dealing with debit and credit, tons of different links that you can go to help you right now, where maybe you're still in your same income level and spending, and kind of get a grip on what you're doing right now to plan for what's going to happen, in a few weeks when you graduate. Anybody done these before? Anybody aware that was there? Okay, great. Do you track your expenses daily? I use Mint. I use Mint. I love Mint.com. I'm kind of obsessive about it, actually, because of course there's an iPhone app for it. And so every day you can get on and you can refresh your accounts. You can link many accounts to it, your credit cards, your checking accounts, your savings accounts. In a snapshot at the very top, it shows you how much money you have. Ideally, that's a positive number. At the top, if it's a negative number, that means you have more debt than you have cash. So Mint.com is great because, let's turn on a daily basis. Can you hear me? On a daily basis, you can track your budgeting. I have a specific amount I try to spend for groceries every month for my family. $800 is my budget for groceries. And the first month I did it, when I had not been tracking anything, I was really pretty sure I was on track, and I think I was maybe at the beginning of the third week, and I was grossly over my $800 budget. And I thought, oh, this is really going to stink the rest of the month. But you really pay attention. If, you know, I track my gas, I track the education expenses that I have for my children, as far as the tuition for my kids in high school and the tuition for my daughter in college. And my oldest daughter just got married, so I was tracking wedding expenses. And some days you're like, wow, that's kind of a scary number. But Mint.com is really a great one. So really just looking at these, seeing which one you think seems to work for you, and then setting it up and faithfully doing it and faithfully categorizing every expense you have. And then at the end of the month to see, where was I over budget, where was I under budget, which that's a great feeling, because then maybe that's money you can save and put into a savings account. Any questions on budgeting? Anybody, who does a budget? Just the one person right now tracking his money? All right. You do. Some people do it even easier. Some people just have a little notebook, and every day they just write it down, every single thing that they buy. That's kind of cumbersome to me, and I know I wouldn't do it. So that's why Mint works for me. Before you leave campus, if you're interested at Purdue Federal, we offer free and confidential budget planning, credit counseling, whatever you might need. If you think you've maybe made a mistake in your credit history, and you think, oh, I'm not sure what's out there, I think it might not be good, or I just really don't know what to do, where to go, you can make an appointment with one of our counselors. They're over at our admin building off of Wynn Henschel by Walmart. We can come anywhere else. We can pull your credit report for you. We can show you the credit report, go over it all with you. If there's items in there of concern, they can help you understand what you need to do to improve your credit score. So that's something we can do for you. We also have budgeting worksheets that we can give to you and help you on your way. So if you think you need a little bit more, happy to do that. We're a partner of the Alumni Association, a financial partner, very happy to do those things. But as a credit union, our mission is to help people. That's why we exist, and that's why we're here. And you can offer these, you can have these services from us whether you're one of our members or not. So please take advantage of that if you'd like to. Okay, somebody had questions about, did I answer all the questions that everybody had about budgeting and I don't want to live on ramen noodles? Because my family was on ramen noodles for that week and a half. No leftovers.
For my credit score, like I guess I got like fraud or something. Someone applied under my name for a credit card and they called it out, but then I wasn't allowed to get a credit card again for like 2 weeks.
Okay, so you had somebody submitted a fraudulent credit application and using your name and social security number, and there must have been a freeze on your credit account.
Like that, yeah.
I'm not sure where the freeze would have come from, because generally that's it's something that you, the consumer, would have had to say to a credit agency. I don't want any activity on my account for this amount of time. So I'm not sure how that would have happened, but that should not have negatively impacted your credit score.
Okay.
Yeah, you should be fine. So have you checked your credit score since then?
Yeah.
You should. And everybody should check their credit score at least once a year, your credit report, just to make sure that everything on there is what should be, especially if you have a really common name, like John Jones or John Thomas, or I don't know, I have a very uncommon name, so unless someone's got it in all my things, I shouldn't have to worry about that, but I still look at it. Do you have a question?
Yeah, I've been told before that it reflects negatively on you if you hold your credit report multiple times in a year.
Okay.
So
There's
once, pull it twice.
Yeah, there's the misconception of, oh, I don't want to pull my credit report because it might hurt my score. When you pull your credit report, you're getting your free credit report? No. If you are applying for multiple credit cards and cars and things like that, perhaps, but we're talking a point or two. We're talking a few points. It's not really going to change your score, and it's maybe only going to be for a couple weeks that it might be that score. So, you don't want to do a lot of that, but certainly once a year, once every 6 months, just pulling your credit report to see what's out there, no, don't worry about that. That should not prevent you from pulling your credit report. Okay. Yes?
I realize the credit scores range quite a bit, but what, as seniors just coming out of college, starting our first job, what's kind of the lower limit that we should aim for in order to be approved for?
Okay, so as a graduating student, right. Are you asking what's a good credit score?
Right.
Okay. As a lender, we have, you might be A credit, B credit, C credit, D credit. We have to look at you a little bit differently as a graduating student because you don't have those opportunities that I maybe have had in my life as I've bought homes and cars and things like that. My credit file is going to look very different than yours. So you might have, it's not uncommon to see a student graduating with a 640 credit score because you have very limited history and types of credit in your file. We have students who maybe only have their student loans in their file, and they might have a 700 credit score, which is a good credit score. But that's not, when we look at that, we don't think, well, that's not really a credit score. They aren't making any payments on that loan. So there's no credit history to that. So we really, as a graduating senior, we're really looking at, do you have derogatory credit in there? You know, do you have charge-offs from cell phone bills or from electric companies? Do you have credit cards that you're currently at the limit or you're over the limit or you've been 60 days multiple times? But at the same time, we understand that as a graduating senior, you know, when you maybe got that credit card, you were 19. You know, maybe you weren't as mature or responsible when you first got it, and that might have been 2 years ago. So we're going to look at all of that. So what the other thing that we look at then is your income. What is your future income going to be? And then what are your fixed expenses? So if you have a car loan, and if you have the student loans that are going to go into repayment, you know, about 6 months after you graduate, and if you have other credit cards, once you've paid those fixed expenses, how much money do you have left? So if you have a 700 or credit score in the mid to high 600s, and you've got good income, you know, those are some of the things we're going to look at. I mean, everybody is different, and so there's no matrix when we look at that. Does that answer your question?
Yeah.
Okay. Any other questions on that before we go on to buying a house and some other things? I wanted to look at there was a question on here, for purchasing a new home as a first-time home buyer, what should my credit score be? Again, I can't tell you that because we don't have that. There's not a rule as a lender, but we're going to look for what is in your credit history. And we're going to look at a younger adult a little different than we might look at me. Not that there's fair lending and everybody has to have a credit score and you get a certain rate based on that score, but there's other extenuating circumstances that can help you. So again, a healthy credit score, mid 600s into the 700s. The highest credit score you can have is 800. We don't see a lot of those. Generally, you know, 680 to 720, 740. Those ones up above 740 up to 800, they're out there, but they generally aren't getting new credit, so we don't see a lot of those. Someone asked, how much should a first-time home buyer have to put down? As a lender, you know, there are different types of loan products you get based on how much money you put down. You can put, when my husband and I bought our first house, we put 5% down. We wanted to buy a house. We really hadn't planned to buy a house. We kind of looked at the tax ramifications of not buying a house that year. It was like, wow, we're going to owe a lot of money at the end of the year if we just continue renting. So we put together as much money as we could. We bought a house just to get into something to have the tax benefit of it. But by only putting 5% down, we had to have something special called PMI insurance, private mortgage insurance, because we didn't have a 20% down payment. So yeah, we could put 5% down and we bought the house for the tax, you know, benefit. But then we had to have PMI insurance, and we had to have that until we had enough equity in our house that we had a 20% down payment. So, you know, again, there's no great rule. You have to weigh it on other things in your life. You know, yes, we could have waited till we had 20% down, but then what other money might I have paid for taxes because I didn't have the tax benefit of owning a home and the mortgage interest that I could deduct on my taxes. Does that make sense? You guys have heard of that before? PMI insurance? Okay. And it's not uncommon for us to see new Purdue grads buying houses. You know, I mean, buying houses are expensive, but sometimes they make sense. Yes, do you have a question?
Yeah, I have a question that's kind of unrelated to home buying. When you were talking about the credit score, I was thinking of those commercials that are like freescore.com, and they said that like some credit scores are like 700, 720, and then one was like 500. How can 3 different companies report your score? Like 2 of them were the same and one was vastly different.
Well, I don't know that I can speak for whatever that commercial was. I mean, every Equifax and TransUnion, you know, you can pull your score on both of them, and they might not be exactly the same. And the score that you pull for your free credit report, that's going to be different than the score that we're going to see as a lender. The whole credit file and credit scoring, it's still a mystery. It's not, and even for the issuer. So your credit score should be somewhat within the same range. You should not have 3 scores from 3 companies and have a 700 and close to a 700 and a 500. If you did, then I would definitely be looking at what's on that report from the $500, or excuse me, from the 500 score to see what's on theirs. Do they have something on there that's not supposed to be on there? That would be my assumption. Does that make sense?
Yeah.
Okay, great. Okay. Buying your first home, as a mortgage provider, we suggest getting pre-qualified before you shop. You know, knowing about what can I afford, what should I continue, what should I think I can look for. Also, with the knowing of, you don't want to be house poor, meaning you don't want to have all your money just paying for that mortgage payment. Still wouldn't have money to go. So I have 5 minutes left, so let's get going. You want to get pre-approved before you make an offer, and that's where you then come in with all of your financial documents and how much you make, and we're going to then at that point, or financial lender would then at that point tell you specifically how much you can be pre-approved for before you go out with a mortgage lender to find a home, and then know what type of mortgage you want, because there are fixed mortgage, there's variable rates, so knowing those type of questions. Does anybody have any other really specific questions about mortgages? Okay, great. Buying a car, anybody can be buying a car. Don't make a deposit on the car before you're approved. Know the value. If you have a car you're trading in, get on Kelley Blue Book value and try to look that up. Answer it honestly. We all like to say that our car is in great condition, but probably it's in, you know, if you used your car like I've used my car, it's probably in fair condition. So know what your value is, and before you go to buy a car, you might want to get pre-approved for a car with a financial institution. Car dealerships do financing, but the bottom line is they make money off of financing your car. So does it make sense to always get your financing at the place that's selling your car? They know cars. That's what they know. Banks and credit unions know financing. So make sure that you look around and make sure you get the best deal. If you are buying a car and you look through the list of how much everything costs, a lot of times they'll come back and say, I can get you in this car for this payment. How's that? Ask how did you get to that payment? How much did this car cost me? What are the other fees? They have things like called doc prep fees. That's just completing the papers for you, and they charge you a $300 or $400 fee. That's crazy. You shouldn't have to pay that. So do your homework before you buy a car. Any questions on buying a car? Okay. Saving money. I know there's some questions about that also. When you get your job, you need to establish how much money you're going to save every month. It's important to start saving at a young age. Pay yourself first. Put money in savings first, then pay your bills, and then have your fun. But put money in a savings account. You can make your payment automatically to your savings account, payroll deduction, or direct deposit, or like a holiday club account. I want to talk a little bit about saving for your future. Starting an emergency fund. You never know what's going to happen. You might have a big expense the next month. You need to have some emergency funds set up. But you know, just start small. Keep going, and it will grow and it will build. A 401k program. Does everybody know what a 401k is? When you go to your job, one of the benefits your employer might offer is a 401k. And that is money that you can put in for a savings for your retirement that's tax deferred. So if your salary for your pay period was $1,000 and you put $100 in your 401k for that salary period, your taxes, all your taxes that the state and the local government and the federal government are going to assess on you are only based on the $900. All that $100 in your 401k goes in tax deferred. So these are tax deferred savings. So some employers, you just put your own money in and that's your savings, your nest egg. Some employers also might match what you put in. So if you put in 100, they put in 100. That's a great deal. Yes?
If you switch jobs, do you lose all your 401k?
That is an excellent question, and that is a mistake that many people make. I think I have it still in one of my slides here, but I don't want to go ahead yet. But no, you're fine. It's a great question. I saw the statistic last week on bankrate.com. 60% of American workers have less than $25,000 saved for retirement. I was like, wow, I'm thinking they're not retiring. But what happens is the time of starting at a job when you graduate from college and staying there the rest of your lives, like maybe your fathers or maybe your grandfathers did, that generally doesn't happen. Many times you will switch jobs every 2 years, every 5 years, every 10 years maybe, and it's very important that you have a plan for your retirement funds of what you're doing with the job you leave. most employers don't want to administer those funds for you anymore. They want you to take them. So you then need to have a plan for where you're going to roll that money into. You can roll your 401k in a Smith Barney account with other financial investors, but you need to have a plan of always where you're going to take that money. So the reason that most Americans have less than $25,000 saved is because when they change jobs, they just got a check dispersed to them for their retirement funds. I actually this week got a check. I nearly 10 years ago worked for the county here in Tippecanoe, and I worked there less than a year, and I had completely forgotten that one of the benefits as an employee I had was the Public Employees Retirement Fund, and I had a very small amount of money in there, and I got a check for that this week. So, you know, you're like, woohoo, money from heaven. But it's like, no, it's not. I need to roll this over into something that was a similar product. So that's one of the things you need to remember. So great question. So 401k plans, that's something you can contribute to, or some employers will put money in there even if you don't. That's kind of stopped over the last few years as the economy was difficult for some companies. So generally it's you funding it yourself. So make sure that once you're eligible for a 401k that you're putting some money in there. It can be 1%, 2%. Just put money in there and save as much as you can in those early years, so that you can, you know, by the time maybe you are a little older and you have a family perhaps, and those more expensive years, and you want to continue saving, but you have the flexibility if you'd like to take a little bit of a break and slow down a little bit. Setting up an IRA, an individual retirement account, those are, again, an IRA is a tax deferred, meaning you put the money in and you're not paying income tax on that now, but a Roth IRA, that'd be money that was already taxed. I'm not an investment counselor, but and I can tell you that a little bit about it, but if you really are interested in specific information about investing, you can make a free appointment with our investment service department, and they'd be happy to help you get started on some things too. Any questions on that? Student loans. If you have student loans, I hope you know how many you have and how much. One of my daughter's friends that graduated a few years ago, she's a physical therapist. My younger daughter's physical therapy, so we were talking, and she was telling me how great it was to be out of college and set and the other, and some of the responsibilities that she was really prepared for, and she didn't really realize she had $60,000 in student loan debt. And so now she's like, that kind of bites, that takes a chunk out of my paycheck. So she really didn't know. So when you pull your credit report, it's going to show exactly how much you have. So hopefully if you have those student loans, you know. Do you know when your payments begin? If you don't, figure that out now, so that you're not caught off guard when all of a sudden you have a payment due, and you got your job and you moved to an apartment and you bought a car because you thought you could afford it all, and you didn't take into an account that your student loans were going into repayment. Okay, set up automatic payments so that you don't miss a payment, so you don't have penalties. It can very easily happen, so take that with you. Any questions on that? And getting ready to close, one of the things, keep your identity intact. You know, don't make the mistake of letting someone else benefit off of maybe your hard work and building a credit score over this next year or two as you're a young adult and doing more. Keep your Social Security card at home. Don't carry it in your wallet. You know, my daughter, she's a lifeguard, and she got rehired this summer. She said, oh, Mom, I need to take my Social Security card in next week, as everybody does when you get a job, you have to prove who you are. I said, you don't have to take your Social Security card. So yes, I do. I said, no, we will give them a copy of your card, but we're not giving them your card. And you know, and so there are different times you go to the doctor's office and they will ask for your Social Security number on that form. You do not have to give it to them. Anytime someone asks for your Social Security number, unless you are applying for a loan, they probably don't need it. Yes, when you came to school and you applied for student loans and things like that, but always ask, why do you need my Social Security number? That is a really important number to you, and that can really make your life difficult if the wrong person gets it. We see fraudulent applications for loans on a daily basis. We know that it's not the person who's applying. They've somehow obtained somebody else's credit card numbers or Social Security numbers, and they're trying to get more information. So keep that. Check your credit report annually for all the reasons we talked about already, but also to make sure everything on there really is your debt, really is your responsibility. Shred your bank card statements. Anything that comes in the mail, don't just throw it away. shred them. Invest in a paper shredder. Many institutions or businesses have a local shred it day. So if you do keep it at home in a box with the intention of I'm going to shred it someday or take it somewhere, take advantage of community shred it days that come from a secure location. And don't carry your extra IDs with you. When you think about what you have to prove as a person to get a job and what you have to prove as a person to get a driver's license number, you should never be carrying all those kinds of things together, because if you've got them all together, someone else can prove that they are you, and they're going to take advantage of maybe what you have built through the years. So anyways, again, just to let you know, we're here to help. If you want any help before you leave campus, we're here to help even after you leave campus. The free credit counseling services, the free financial advisors. We have locations here on campus as well as in Lafayette and West Lafayette. We have 4,000 shared branches, meaning other credit unions that you can walk into throughout the United States as if you were walking into one of our locations, and ATMs and our largest ATM network. So I'm happy to be here. I'll be here later if you guys have any other questions, and I hope that I answered everything. Where's the best place to look for jobs? I'm not sure why I got that question, but looking for a job is good. I will say, surely you're doing LinkedIn, but joining all the different groups that might be part of what you're doing, looking for different kinds of groups. Purdue is a great group. If you're not on the LinkedIn Purdue group, that is a great one. I see on a daily basis lots of job offers or job positions in the Chicago area, as well as many engineering positions throughout the United States. So if you're an engineer, I think there's lots of jobs out there. At least that's what I'm seeing on LinkedIn. But again, there's so many places. I'm sure you're all into social networking as far as Facebook. Careers After College is a Facebook link that I follow, and see lots of information on that. So I think I answered one question. Is it possible to purchase a home with nothing to put down? I don't know, but I wouldn't do it. It just, if you can't afford to come with the down payment, I think other things might be harder for you too. So anyways, thanks a bunch.
Sorry. Okay, that was Stephanie, and she did say she'll be around later, so if you have any last minute questions, that would be a good time to ask afterwards. And our next speaker is going to be, he's going to go get water, so, but it's going to be Brian Rada from Liberty Mutual. So if you guys want to, if you want to use the bathroom or get some cookies, that would be a good time right now, real quick.
That's fine. I'm good. You gotta go. Did everybody get my handouts that I sent out, or did I send them too late?
They were set out on the table.
Okay, I know we're gonna be probably cutting it pretty close on time. Are we doing okay?
Yeah, we're doing okay.
All right.
They give you all about 35, 40 minutes.
Did you say it's going to go the longest?
No, I have a feeling.
That's right. Insurance is about as exciting as watching paint dry, but it impacts every aspect of your life. We're still waiting on a couple of people. I'll tell you what, while we're waiting for everybody should have gotten a handout that says Home and Auto 101, and there's a 10-question quiz. Just in the interest of time, why don't you go ahead and do me a favor, run through those 10 questions. That's going to be the bulk of what we're going to talk about today. And as we talk about, those questions, what they are, why they impact you, there's going to be a lot of carryover in terms of other areas. And as you have questions, don't feel like you need to wait till the very end. Just feel free to blurt them out. I'm happy to answer for them and see what we can do for you. No cheating either. This is the higher education area, right? Is everybody back? All right, good. We'll do that, and then I'll do a quick introduction. You don't happen to have an extra one of those, do you? Just so I can not be staring back every 2 seconds.
Is there an auto insurance coverage? No, oh, no one is. Say yes.
You got a group project going on right there?
If your car is stolen,
I see you got a group project going on. Cheers.
should you cancel your renter's homeowner policy?
It's my favorite part because everybody starts trying to reason it out. You can get me. I don't mind the shepherd's hook at all. I tell people I sell insurance. I'm an insurance agent, and it's insurance is definitely not the most exciting thing you can talk about. But as a salesperson, I just have learned to chit chat, my way into hours and hours and hours. How are we doing so far? Did everybody get a chance to actually fill out the quiz? You have to start feeling, well, what about this? What about that? And, well. Should we give you the Jeopardy music? No. The do-do-do. All right. Maybe another minute and we'll get started. Did you get the? You better get it. All right. Well, let's get started here because I'm sure that there's a lot of important things to do between finals coming up and the end of the year, and it's being nice outside and lots of sunlight. You probably want to be able to get out there and enjoy the evening a little bit. But you recognize that it's important for you to be here tonight, and so that's good. I'm glad that you guys came. Let me give you a quick introduction. My name is Brian Rada, and I work for Liberty Mutual Insurance Company. Yesterday I actually celebrated 4 years with Liberty Mutual. I've been in insurance though for over 8 years, and so I have quite a bit of experience and worked for other companies as well as had my own agency for a while. And so I've got a lot of different experience from that. And as you have questions, feel free to stop, ask me some of those questions, what your thoughts are about insurance. I know, as you probably heard me say, insurance can be about as exciting as watching paint dry, but between home insurance, auto insurance, life insurance, health insurance, accidental death and dismemberment, all the different types of insurances that are out there, it plays a role in every day of your life. And every time you turn around, insurance is going to be somewhere where you're at. And the sooner you learn about it and know how to navigate through it, the better off you'll be in the long run. So Liberty Mutual actually has been in business now for 100 years. Liberty Mutual started in Boston in 1912 as a workman's compensation company. But 2 years later, we started selling auto insurance. A couple years after that, we started selling home insurance. And what's happened actually is Liberty Mutual has grown. We're in the top 5 in terms of overall home and auto writers in the country for personal lines insurance. But most people don't know a lot about Liberty Mutual other than our commercials make you feel real good. We don't have cavemen, we don't have havoc, we don't have a guy, chasing you down or falling off roofs. What we have is those real nice commercials that make you feel good and go, oh yeah, I should do something nice for somebody today, right? And so Liberty Mutual, huh? Did you say you cry at my commercials?
No, I love those.
Oh, you love them, okay. Say, if you're crying, I think we need to scale it back a little bit. So, Liberty Mutual, though, we are, the reason why we're such a big company is because we have strategic partnerships, actually, with over 13,000 different organizations around the country. The big thing I can tell you is that Purdue, the Alumni Association, and Liberty Mutual has formed a partnership for a number of years in which we actually offered alumni of Purdue a 10% discount off your auto insurance simply because you went to school here. And a 5% discount off of your home insurance, again, simply because you went to school here. The reason why we do it is we form these strategic partnerships with different organizations and institutions around the country where we know that we're going to be dealing with a higher class of individual when it comes to risk management. Whether or not people buy into it or not, the higher the education level you have and the better the education you have, the fewer claims you make over your lifetime. It's fact. And so we've partnered up with great schools like Purdue to be able to offer you special discounts because we know who you are and who you're going to be throughout your life. And so we're able to offer you a much better program and a much more direct service. And that's why we really don't have the cavemen. That's why we don't have havoc, and we don't have all these other issues that are out there, because we're focused on actually partnering with you for the long term in terms of being a good partner for your life and not just saying we want to entertain you for 5 minutes, save you a few dollars, and if you need us, we may or may not be there. So that's who Liberty Mutual is. There's 10 questions I really view as being absolutely important and essential, and those 10 questions evolve over time. So if you've been in this class before with me, or maybe you're lucky enough to be part of the Alumni Association here on the staff and you have to listen to me every 6 months, there's different things that'll come up in each of the classes. So again, I just simply encourage you to look at what we're talking about tonight and see what we can do. Now, question number 1, as we get on there, who's got question number 1? Who sees that there? Who wants to read it out loud and give us your answer?
Okay, question number 1, if you hit someone with a golf ball on accident, will home insurance provide coverage for injuries?
You must be a terrible golfer, by the way.
Or a really good one.
with the caveat
Touche.
With the caveat that I don't actually know the answer, I put no.
You put no. He says no. Okay, so the question is, if you're out golfing, right? Either you're on the course or in your backyard, right? And you're like, man, I just love this new club. And you start hitting the ball, and you realize that you just shanked one. It goes right over the fence and it hits your neighbor, and they're hurt. Are you going to have coverage from your home insurance policy? Who said no? Okay. Who said yes? Who didn't know and didn't write anything down, or just guessed altogether? Pretty much everybody guessed. Okay. Well, here's for being a good sport.
Not shanking.
That's right. I didn't shank you. That's right. This isn't a prison. So here's the issue. Why did you say no?
It seems like something you should be able to control.
Okay. But it's an accident. Let me give you a real life example. I was golfing with a friend of mine a few years ago, right? And we're literally sitting in the golf cart waiting to tee off, and all of a sudden you just hear, did you hear something? You hear, what? Is someone saying four? And all of a sudden I get hit right in the leg with a golf ball, right? This guy in a different hole just caught a hold of this thing and hit me square in the leg, and it hurt like the dickens. He accidentally hit me with his golf ball. Now, what if I sued him? Does he have to pay that out of pocket? Nope. If I sued him, he accidentally injured me, your home insurance policy carries with it what's called liability coverage. Okay? It can be as low as $100,000 and typically can go up to $1 million in coverage. But because he accidentally hit me, if I sued him, his policy would have covered that. Okay? Now, the one thing I tell everybody is that it can also happen. Is anybody in here, got finals coming up? Yeah? Is life after graduation? I'm assuming we're all seniors, right? We're getting ready to graduate. They do test you before you leave, right? Okay. Just want to make sure. But you ever get so busy that you're at the grocery store and you're walking down, you got the cart, and you don't even realize it, and you walked right past the cereal you meant to pick up? I have that go on all the time. I can't tell if I'm just getting dementia at an early age or if I'm just that stressed out and busy. But if I accidentally walk right past that grocery aisle and I hit somebody with my cart, I accidentally injured them. Okay? So that would be covered as well. Maybe a little bit more practical example of something that could happen. But if you see your old roommate who still owes you money and you hit him with the cart and be like, oh, I missed you, I'm so sorry. That's not going to be covered. We're not going to pay for your revenge. All right. Any questions about that? Pretty straightforward, right? Clear as mud? Okay. All right, number 2. Who's got number 2 wants to read it first and give us your answer? I will call on you. All right, we got an I will over here. Look at that, I'm 2 for 2.
Does homeowner insurance provide coverage for flood damage?
What do you think?
I said no.
She says no. Okay, what did you guys put? Who said no? Who said yes? But it's a flood. It happened in your house, right? Why did you say no?
When I saw commercial ones trying to get people to buy flood insurance.
Okay. Do you remember who was offering the flood insurance?
No.
It says Liberty Mutual.
Oh, it was?
No, he said Liberty Mutual here. All right, so flood insurance. Here's the major issue. When you go to buy your house for the first time, right, you're going to find out whether or not that house is in a floodplain. You go, floodplain? What's a floodplain, right? Essentially, if you have rivers, if you have lakes, if you have stuff in the area that could overflow if there's a torrential downpour, right? If all of a sudden the nastiest storm of 100 years shows up and it dumps all the water in that creek or in that river and it flows over and floods your house, that's considered a floodplain. Those areas where that could potentially happen, right? Now, if you live on top of a mountain in the middle of Nevada, it's not a floodplain, okay? Now, if you live, near the lakes here, yeah, floodplain. And so what will happen is, in those floodplain situations, flood insurance is only offered through FEMA, right, the federal government. They're the only ones that are going to actually be able to write that policy for flood insurance. What's interesting, though, is that they actually turn the writing of that policy, all the maintenance of that policy, over to different insurance carriers, right? So if you come to me and you say, hey, I live in a floodplain, and I'm required to buy my house, I have to get flood insurance, we can help you write it, we can help you get it, but the same rate you're going to get with me, you're going to get with anybody else that you buy that through, because it's set by the federal government. Okay? So no insurance company is going to put that on your home insurance. It's going to be done through FEMA. All right? Make sense? Yeah? All right, how about number 3? Who wants to do that? We have one over here. All right, read it loud.
Is there an auto insurance coverage known as full coverage?
Full coverage, everybody hears about it, right?
I bet there is one, but I bet it isn't full coverage.
I do not understand your answer.
She says yes.
She says yes,
Yes.
okay. She said yes. Anybody else say yes? Anybody else say no? Anybody else starting to feel like I'm trying to trick you with every question? At least you're honest, okay. So why did you say yes? Okay. There's a pattern here. I ask you what you say, I ask you why you said it. She goes to eat right there. Thought I was going to give her a break. Why do you say
Full
yes?
apple slice. I bet there's one known as full coverage, like that's what the name is, but I bet it isn't actually full coverage of like everything.
Okay. So here's the issue. The answer is no. If you call an insurance company and you say, hey, I want full coverage, we all know what you're talking about. Full coverage typically means that you want liability in case you injure anybody, and then you want 2 other coverages. One's called comprehensive. That's if your car is stolen, vandalized, damaged due to wind, hail, theft, or fire, or if you hit an animal. The other one's collision, right? The fender bender, the parking lot, someone hit my car and took off, that's collision. There's comprehensive, and then there's liability. Those three together are typically referred to as full coverage. But on an insurance policy, if you look at anything, there's nothing that's going to actually say this is a full coverage policy. It just doesn't exist. It's just a term that people use to be able to kind of condense from saying, hey, I want liability and comprehensive and I want collision. So if someone offers you full coverage, you should ask them, well, what does this really entail? Is it liability? Is there comprehensive? Is there collision? And then what are my deductibles? What portion am I responsible for if I wreck my car? Right? So that's your deductible. If it's $500, you pay the first $500, then the insurance company will fix or replace your vehicle depending on the damage. All right. Number 4. Who's got number 4? Oh, here in the back. You want to do number 4 for me?
If your car is stolen, will your personal property in the car be covered by your auto insurance?
What do you think?
I said no.
You said no. Who said no? Who said yes? Okay. Why did you say no?
I was thinking your personal property might be under your home insurance.
Okay. It's an interesting thought. It's in the car, though. Car was stolen, you have coverage for theft. You want to change your answer?
Sure.
You shouldn't have changed your answer. No, you're dead on, in fact. That's one of the first times I've heard somebody really get it right there. Your car covers your car. Your car is your car is your car. Your home, though, has a coverage on there called personal property, right? Your personal property is covered anywhere in the world. You decide you're going to go to Thailand on vacation, and you go back to the room and your bags have been stolen, your insurance company will cover that, okay? Now, if it's in the car and the car gets stolen, same thing. It doesn't have to be in Thailand for it to happen. It could be just out in the driveway, someone decides to steal your car. You had your iPhone, your iPad, you had your books, you had all of your belongings in the world. You know, you're one of those types that you open up the trunk and you could be a survivalist, right? I mean, you've got a tent and you've got a sleeping bag and you've got groceries, right? Okay. All of that would be covered under your personal property. I'm going to try and get it back there to you, but watch out. All right. We're doing good so far. All right, number 5, right? Number 5. Who's got number 5? How about here in the front?
Should you cancel your renter's or homeowner's policy the day you move out?
Okay, so the question is, should you cancel those policies immediately when you move out? What'd you say? You said no? Okay. Who said no? Some people just aren't answering at all anymore. Who said yes? Okay. Well, why did you say no?
Well, like if it's your homeowner's and just because you move out doesn't mean the house is sold yet.
Okay, well, let's say that you sold the house. House is sold. Should you cancel it? You still don't think so. Interesting. Anybody else have a different answer? Chime in.
I agree, like, if you move out, but if you still have stuff in your home.
Okay.
I mean, if you move into another home and you're not living in that one anymore, is that, I don't know, I guess I'm confused on this, but would that cover things that you still had at your old residence?
So if you move into a new house, does that cover the things you have in your old house? Is that the question?
I mean, I'm assuming you have to change policies.
Okay. So there's some of that going on here. I'll answer all of it. I just want to see what else is coming out.
I said no because maybe like your renters or homeowners covers the stuff while you're in the process of moving.
Man, you guys are smart here. Tell you what is this, Purdue, right? Yeah, all right, so the answer is no, you shouldn't cancel it. And here's the reason why. For about a 30-day window after you move out, whether it's your home or your apartment, the big issue there is this. Your personal belongings are in transit going somewhere, right? So to give you a prime example, when I was 15, my family packed up our house in Northern California, and we moved here to Indiana. Okay. Now, don't ask me the validity or the thought process behind that, but we moved from California to Indiana. And when my parents packed up, they packed up everything that they had of their earthly possessions. I mean, everything that you could imagine that they had was packed into this giant tractor trailer thing. Okay. We had to stay in a hotel for I think 3 or 4 days after we moved here because the house, hadn't closed yet. Well, what if we'd have gone outside and someone would have stolen that trailer? Everything that my parents had would have been gone. And if they would have canceled their policy as soon as they had sold the house and moved out, That means all of their possessions would have been gone, and they'd had to pay to get them all back. Now with your home insurance policy or your renter's policy, it covers you while you're in transit. If you buy a house or you sell your house and you buy a new house, yeah, you have to exchange policies. Typically with your renter's policy, if you're just moving from one place to another, I can just change your address, your policy stays the same, everything's fine. But the issue is that you want to be able to make sure that you have coverage while all of your belongings are in transit. So you talked about, you know, buying a new house and having it on the old one still. You can certainly do that if you're buying a house and this other one hasn't sold. You can get a secondary policy and there's some coverage for that. That's kind of a not too complex of a situation, but it's more rare. You know, the people are sitting there on houses like that, and we can certainly help you answer any of those questions. Anybody have any follow-up questions to that one though? Doing good so far, right? All right. Who wants to read the next one? Should be number 6. Right here. All right.
Will my parents' homeowner's insurance policy cover my personal belongings while I'm away at school?
That's an important one, isn't it? What did you put?
The answer is yes.
The answer is yes. She says that with confidence. Why do you say it with such confidence?
One, because they're personal belongings of yours and they're just in a different place, so it should still cover you. And secondly, because that's how I have insurance here at school, is it's on my parents' homeowner's policy.
Interesting. Anybody say no? Nobody wants to, after she answered with such kind of bold confidence, nobody wants to contradict her, right? I'm going to give you that one right there. The answer is you are covered under your parents' policy while you're here at school. Now let me tell you about that for a minute. Usually, if you have a child away at school, 10% of whatever your personal property coverage is, so I'm going to give you some real easy numbers here, okay? Obviously, you guys go to Purdue, so you're great at science and math and engineering. I'm not, okay? So on a homeowner's policy, let's say you have a house that's for $200,000. Typically, your home policy will carry with it anywhere from 50 to 75% of that amount for your personal property. So it could be anywhere from about 100,000 up to 150,000 in personal property, right? That's couches, tables, chairs, everything. Well, when you look at a child away from home at school, 10% of that amount usually goes towards that child that they're away, because technically they're still on your policy. Now, I'm going to give you some information about that as well. Anybody in here claim themselves on their taxes? Everybody still dependent on their parents' taxes, right? Okay. Now, I was doing some research on this because this question comes up a lot, and I wanted to give you, the most solid answer I could. So long as you have, so long as you're dependent on your parents' policy, and usually under about 24, even if you go over to graduate school, even if you decide, hey, I'm going to go up to Chicago for a little while, I get this job offer or this internship, I'm going to go there, you can still have coverage under your parents' policy that'll extend. What you need to do is talk to the insurance company and have them actually make a little addendum or an endorsement, as we call it, on the policy saying, we're also insuring these belongings at this residence, okay? So make sure that if you're doing that, if your parents own a house or they're renting even, that they talk to their insurance agent and have that coverage for you. But once you start claiming yourself on your taxes, that's where you're going to need to have your own policy. Okay? All right. Very good. She obviously picked the one that she knew the best, though. She's smart. When you own a company, let me know. I'll come work for you. I like that. All right, number 7. Who's got number 7? Number 7, anybody? You got number 8. I saw you raise your hand last time too.
If you buy a home for $200,000, does that mean that you need to insure the home for $200,000?
What'd you put?
I put no, but I didn't know really.
Okay. You put no. Anybody put no? Anybody put yes? Nobody? You guys just stop answering. Whoever answers the first question, nobody wants to contradict them anymore, right? So I'll give you the quick answer to this. If you buy a house for $200,000 in this economy, here's the problem that you might run into, especially depending on markets. If you buy a townhome in New York in Manhattan that's 2,000 square feet, it's going to cost you what? A couple $1 million, right?
Yeah.
Now you buy that same exact condo inside and out, but it's here downtown Lafayette. Is it going to still cost you $2 million? How much is it going to cost you? He's the best answer for that. He's got lots of information. About 200,000. Not 2 million though, right? So I can get 10 of those. So that's why I live in Lafayette. I get 10 of them. So here's the issue. You don't want to buy, or you don't want to insure the home just arbitrarily for the amount that you're buying it for, because what it costs to buy and what it costs to replace is two different issues, right? There's so many other numbers that are going to be associated with that. What you really need to figure out is, you know, how old's the roof, how old's the structure, you know, what are the cost of building materials, what's the cost of labor, and your insurance company should have a calculator, all of them do that I'm aware of, that'll actually go through and ask you a number of those questions, and we'll figure it out. Now, the only issue could be that if you're buying, you know, 6-7 years ago when the real estate market was so hot that you know the house would be appraised at $150,000, but you know you're the expert here, you know, even if it appraised at 150, it might have sold for 175. You know, it was selling for well above market value. So then the insurance company said, hey, look, it only costs $150,000 to replace this house, right? But you're buying it for 175, and the bank, they might say we need to make sure that the insurance is gonna replace the house, and what we need to do is we make sure that we have the exact amount of insurance on the house that we have a loan for, right? So those two things could always be fluctuating like this. What's important though is that you always make sure the house is being insured for whatever it costs to replace. If the bank or the loan officer, if they have a requirement that's going to be different, you know, we can work with them. You know, I've insured houses for $250,000 that only cost on my calculator $210,000 to replace. But that's a condition of the loan, and so we can meet that condition for you. Okay. Number 8.
If someone borrows your car and is in an at-fault accident, will your insurance cover the damage? And I said no because it didn't specify what type of insurance policy you have, and I think you would have to have liability insurance for that to cover.
Okay, let me give you a ball here. Anybody else put no? Anybody put yes? Anybody ever crashed their friend's car? It was 2 in the morning and there was fresh snow, and I don't drink, but the fresh snow got the best of me, and I went right into the median. When the car turned this way and then turned this way, and I was spinning out, and I remember going into the house going, hey, who's your insurance company? Let's have a conversation about that. So here's what happens. If you have coverage on your car, liability, if you have comprehensive collision, if that person borrows your car and they're in an accident, your policy will pay out because you gave them permission to drive your car. It's that simple. Your policy would extend to anybody who's an incidental operator, right? I mean, let's be honest here. There's something called a designated driver for a reason. That's good. There's nothing wrong with having a designated driver. If you go out and you have one too many to drink, somebody else is going to drive your car home. But if they're in an accident, that shouldn't exclude the fact that you have coverage in that vehicle in case something happens, right? So that's the good thing to know. Now, if somebody, let's say it's your roommate that's driving your car and they drive it every single day and they drive it more than you do, then we need to rate them on your policy. We need to add them to your policy as a driver if they're that often. But if it's someone who drives your car and says, hey, look, you know, my car's broken down, you mind if I borrow it? I just got to run to the grocery store, and they're in an accident, we're going to cover that.
What if your car's stolen?
Yeah. While somebody else is driving it? What if you lend your car to a friend and they steal it? Is that what you're asking? If that's the case, you need better friends.
Does it matter what type of policy you have, like liability, comprehensive?
Well, what'll happen is your policy to drive a vehicle on the road, you have to have liability coverage, right? Now, whether or not you have comprehensive collision is up to you, and you have a lot of those factors that are in there, right? You know, whether or not that the let's say it's a 1970s, you know, and it's just that beater that just won't die, and you just love it, and it's got 400,000 miles on it. Okay, you can still drive that car and say, hey, look, I just want liability. If it gets stolen, I don't care. Now, the insurance will always follow the vehicle and then the driver. So let's say that your friend was driving, they were in an accident, and on their policy, on their auto insurance, they do have, you know, comprehensive and collision. Well, liability will pay out under your policy, and then your insurance company or you might go back to their policy, right, to your friend's policy and say, hey, look, they caused an accident in my car, they have comprehensive and collision, we need you to pay for my car. That's something that the claims adjusters would work out, but that has happened. All right, who wants to do number 9 for me? Oh, right here in the front row.
Do you need to buy insurance from the car rental company? I put no.
put no. Didn't you see that episode of Seinfeld?
No.
Who else put no? No, anybody put yes? Okay, so this is the great debate. This is one of the most often asked questions I hear, just nonstop. If you have comprehensive collision on your policy, and you're driving the car in the rental car and you're in an accident, your insurance coverage will pay out to fix the car as well as to protect you against any kind of liability damage that you may have caused. So technically, no, you do not need to buy the insurance from the rental car company. Now, one of the things that they might try to do is say, well, you have to pay us for our lost wages, right? The money that we would have made had you not wrecked our car. But in order to do that, they have to prove that they couldn't get another vehicle in the entire state and that you had literally wrecked the last one that was available, and now they are totally lost in their income. But if they have another rental car that's 50 miles away, guess what? Good chance the judge is not gonna make you pay for those costs. All right, number 9. Who's got number 9 for me? I'm sorry, number 10. Come on, it's just the last one. Can't be that bad. All right, you've been smiling all day. I'm 10 for 10. That never happens.
If you're renting an apartment with a friend, do you both need your own renter's insurance policy? I said yes.
You say yes? Just, you had a 50-50 shot? Okay. Everybody say no? I'm getting a lot of blank stares. All right. If you're renting with a friend, both of you need your own policy. Here's why. Your policy will cover your own personal property. Okay, and I'm paying a policy. Let me give you a wild, exaggerated experience. Let's say that me and my best friend are renting an apartment, right? And he's got a girlfriend, and he dumps her, and he's a jerk to her. And she decides that, hey, you know what? I'm gonna get even with you. I'm gonna take all of your clothes, and I'm gonna throw them away. And he's out, $2,000 in clothes. That's his personal property, right? Well, I'm not gonna let him file a claim on my insurance and make my rates go up, and make them go up for the next 5 years, just because his girlfriend decided to throw his clothes out because he's a jerk, right? It's not something I'm prepared to do. Now, if the policy, or if the house burns down, or the apartment burns down, right? Let's say you left the stove on, the house burns down, and it was me this time. Well, he's not gonna want me to file a claim on his liability policy and make his rates go up for the next 5 years just because, I couldn't remember to turn off the stove. So both of you would need your own policy at that point. That's the important thing. Renter's insurance is cheap. It should be like $10 to $15 a month the most, if you just need a real standard basic policy. Yeah, if you're, 40 years old and you've got a lifetime of belongings and you're renting an apartment or for whatever reason, it's fine. No judgments by any means. But, you might need more than the basic policy, and it might cost you more than the $10 to $15 dollars a month for the insurance. But generally speaking, a basic policy will give you about $15,000 in personal property. By the time you figure clothes, bed, couch, TV, computer, you're probably around that $15,000 marker. Okay. What questions do you have for me that we didn't cover?
How do you set up insurance? Like your own policy and everything?
Okay. Well, what you typically do is you want to figure out, insurance is all regulated on a state-by-state basis. So you can go one of a couple of routes. Calling your local agent is typically the best. For the Lafayette area, I'm one of the local agents here. Okay. Best thing you should do is have someone who's willing to actually sit down and talk with you, whether that's over the phone, if that's in person, working with you, via email. All those things are important. But what you need to do is find somebody who you actually trust. It's not just going to say, oh, you need insurance? Here's a policy, sign for it, and you don't know what you have. Insurance is, like I said at the beginning, it's going to affect every aspect of your life, so make sure that you have someone that can talk with you. But typically if you look at that secondary sheet that we handed out, or that should be in your handout, it'll look like this, right? This is typically the basic information that we need to start a quote for you. It's going to ask, where you're living at. If you live on the south side of Chicago, your rates are going to be more expensive than if you live in Lafayette, Indiana. Okay? Different risks associated with it, just the way it is, right? And what they'll do is they'll pull from the different national crime rates. They'll say, hey, how often are cars stolen in this area versus that area? How often are houses burned down? How often do you have issue with arson? How many types of losses do you have? But they're going to look at things like, as I mentioned earlier, do you have your college degree? Are you married? Are you a homeowner? Those are different discounts. Typically, if you're married, you drive a little bit more safe. especially because you might have kids in the car. You know, I have 2 kids. I drive a lot safer when they're in the car with me than when I'm in the car by myself. You know, I don't mind if I get in a fender bender, but I don't want them getting hurt. And so those types of things are all calculated and accounted for when it comes to insurance, and they know that, and so they're going to ask a lot of these questions. You know, one of the questions that they'll ask is about your social. You know, there was a lot of talk earlier in terms of social security numbers, things of that nature. If you file claims, that's going to be usually linked to your social security number, and they'll run a property loss or they'll run a driving history loss report, and so they'll be able to link those to your social. So that's one of the reasons why insurance companies ask for it. The better your credit score, absolutely, the lower your insurance rates are. It's just a fact. There's 2 states that I know of that don't take that into consideration. That's Massachusetts and California. Other than that, I think every other of the 48 states do take that into account. So credit score is going to be big to keep your rates low. But you know, if you call, I'll ask you some questions. What is it you need? Why do you need it? What are you trying to accomplish with it? You know, are you concerned about, you know, having the big deluxe, you know, renters or homeowners policy with all the bells and the whistles? Or are you just saying, hey, look, my apartment just requires that I carry insurance, and here are the standard minimum requirements, and I'm on a really tight budget, and I need to get the lowest rate possible? I can help on both occasions. So typically working directly with your agent would be good. Questions? Any other questions? Comments? Anybody like my hair? The last thing, I didn't go through all of these here, just wanted to keep it a little bit lighter, but the last thing about insurance that I did want to talk to you about, and this will, I'll just take a minute of your time because it's pretty straightforward. Life insurance. Life insurance is one of those things that you absolutely need to have a conversation about, and sooner rather than later. This is with Liberty Mutual. This is just an example. If you're 22 and you bought a $500,000 30-year policy, it costs you about $46 a month. You'll hear all the time on the radio or see on the news, hey, we can get you insured for about $10. Right, they can, but you have to die in the state of Indiana, and it couldn't have been for anything other than a satellite falling on you, okay? There's so many specific, like, this, and this has to line up for us to pay out. Otherwise, we just give you back the premium you paid, okay? Versus if you were 42, you bought a $500,000 policy, it costs you about $106 a month, and that's for men. Women live longer, they usually live healthier, so your rates are less. Congratulations, you decided to go with the X chromosome instead of the Y, therefore you get better rates. Okay. Plus, you're typically safer drivers, so we're not so worried about you getting into car accident dying. But there's another piece to this. 22 gets you to 52 on a 30-year policy, versus 42 gets you to 72. So you might hear it, and I might say it to you if you call me and ask me about this. Life insurance is on sale. It's on sale today. It's more expensive tomorrow. Because the older you get, the closer you are to the grave, unfortunately. That's just a fact of life. And so there's a higher likelihood of us having to pay out a claim on that. And so the younger you are, the cheaper it will be. There's term insurance, which says it's just like renting. You sign a 1-year lease. Well, a 30-year term is like a 30-year lease. You've leased this coverage from us. At the end of 30 years, you return the policy. If you didn't die during that time, we thank you for your business. Okay. There's permanent insurance. Permanent insurance is going to be a lot more expensive typically, but there's ways you can pay it off and say, hey, look, I'm going to buy it when I'm 22. By the time I'm 50, I want to pay it off. I don't want to ever pay on another dime of it again. It's fine. We can do that for you. And so you can buy a $200,000 policy, right now, pay for it for the next 30 years, and then when it's paid off, it's like an asset. It's like your house. It doesn't matter when you die. If you died the next day, if you died 40 years later, we will pay out on that policy. And you can also buy policies that you say, hey, look, I'm going to pay on it the rest of my life. It's going to be permanent insurance. One of the reasons why it's important to do that is my wife is she's a type 1 diabetic who had thyroid cancer and an eye infection that only 1 in 4 million people could get in the Phoenix Valley at the time. She is the statistical anomaly if there ever was one. Okay? So the issue with that is if you have permanent insurance, you can buy additional insurance. What they'll do is they'll say, hey, you're 22 when you bought it, you're 42 now and you want to buy more insurance, that's fine, but here are the rates based on being 42 and buying the additional coverage. Doesn't matter if you had cancer, doesn't matter if you were diagnosed with diabetes, doesn't matter if these things happen. That's why permanent insurance is so much better in a lot of ways. It costs more, yes, but you can always buy additional coverage and it's with you the rest of your life no matter what happens, right? So take a look at your things, look at those questions. Honestly, you're at engineering, mathematical science, school. I expect you guys to be brilliant and to have lots of very intricate, detailed questions. and probably don't want to share them with 40 of your closest friends in here. So my contact information is in there. Feel free to call me directly, email me. I will be more than happy to help you answer those questions. Even if I'm not the right carrier for you, I can tell you I have clients who have been with me for years, and I have clients who, I call them clients, even though they go elsewhere for their insurance. They come back to me for the information because I'll tell you, even if you're not going to like the answer, I'm going to tell you the truth at least. So that's the way it is. Thanks so much for your time. Congratulations on graduating. It's a huge accomplishment. You should be very proud of yourselves. Thank you.
Okay guys, we have one more speaker. So if you can give another round of applause for Stephanie and Brian. Okay, and the last thing we promised you that you would learn about tonight is buying a house. And so we have two wonderful people from RE/MAX who are going to talk to you. Brett, and is Greg going to be talking? Okay, Brett and Greg from RE/MAX will be speaking on that.
Hey everybody, my name is Brett Lucan. I'm the team leader for the Lucan Group at RE/MAX, and I wanted to thank you for having us in today. This is Greg Wheeler. Greg's been with my team since December. He was formerly with Coldwell Banker here in Lafayette, and I've had the privilege of working at RE/MAX here for the last couple of years. I was actually formerly with Coldwell Banker here in Lafayette as well. RE/MAX is the largest producing real estate franchise in the entire world, the largest franchise in the country, the state of Indiana, and we have had the largest producing team here in the county for the last 3 years. So I'm personally a lifelong resident here of Lafayette. I did go to Purdue University. My background is in architecture and interior design, so that kind of played into my role of becoming into the real estate industry here in Lafayette. So we're very happy here to come into Lafayette and also come in here to Purdue tonight, talk to you guys about the buying process. We're going to talk to you about mortgage rates, the actual process of buying a house, and also the possibilities of renting, because that might also be a good option for some of you guys. So, Greg, you want to talk a little bit about yourself here before we get going?
Sure. Brett said most of it. I am also from Lafayette, born and raised, and I did not go to Purdue. I went to Ivy Tech, studied business management there, and I worked at State Farm for a couple of years, and now I'm doing the real estate thing. So. Yep.
Okay. Kind of give you a little bit of history about myself. When I got down at Purdue, I knew that I was going to stay in Lafayette for quite some time. I worked down in Indianapolis for about 18 months, so I decided that I was going to go ahead and look into buying a property, just because I knew that I was going to stay in the Lafayette area for at least 5 to 10 years. So at that time I knew it was going to be a good, wise decision for me to go ahead and invest into real estate. At that time I went ahead and hired and sought out for a licensed real estate professional to help me, which I think is kind of the key thing that you should look for when you're deciding to either buy and or rent. A lot of things that people don't realize is that a real estate agent can actually help you find a good quality rental property. There's kind of a difference between renting an apartment when you're in college and actually going out into the professional world and looking for maybe a higher end type rental situation. Most real estate agents in marketplaces will actually represent you in a type of atmosphere that they will help you find higher end rental properties. They get paid through the leasing agencies and things like that. So that's one thing that we'll go into a little bit more detail. So about 5 years ago, when I actually went into the marketplace and bought my first property, there was a lot of government-backed mortgages that were available at the time. So for example, when I bought my first house, the sellers paid my down payment, all my closing costs. I actually walked away from closing with cash in hand. Those things aren't available anymore, but that was the thing that I decided to do at that point in time. Greg, currently you rent right now because of your because you weren't positive you were going to stay in Lafayette. Correct. So now that you're staying in town, Greg's going to be doing some other things. So right now I think we're going to kind of talk about the buying process, kind of start with that, then we'll go into more of the rental options at a later time. So The first thing I wanted to kind of go through is Realtor.com. That's kind of the forefront of where all the latest information is available in the marketplace. You can find licensed real estate professionals, rental properties, active listings. That's going to be really your key website that you're going to be able to find all the latest and greatest information. Greg went ahead and put it up here on the computer, which should be behind me as well. This is really the best possible place that you can go on to find the latest and greatest information. Kind of going through the different mortgage options that are available. If you find a qualified real estate agent, they should be able to lead you in a good direction on being able to find you, or at least recommend a couple good qualified mortgage lenders that you can speak with. For example, here in Lafayette, we do have a good relationship with PEFQ, or Purdue Fed now. They do a great job with being able to qualify you for a home loan, and there are many, many different options available with buying a new property. There are low down payment options available. If you have more money to put down, that's also great as well. On your handout that we have here, there's really 4 main types of mortgage options available on the marketplace right now. You have your standard conventional mortgage. A standard conventional mortgage, you can put as much down payment as you like, but there are new products available where you can put as little as 3%. And 3% down on a $100,000 or $120,000 home is a pretty reasonable amount to invest in a new home purchase. If you don't have your 20% down payment, you are going to have to purchase private mortgage insurance, which is essentially the amount of money that you don't have to put down up to that 20%. So your mortgage lender is going to have to purchase that private mortgage insurance to pay until you have that 20% down over the life of that loan. Most of the time, these conventional mortgages are either held in-house, like at Purdue Fed, or some of these other brokerage companies will sell your mortgage off on the secondary market. FHA home loans are a great product for first-time home buyers. You know, myself, when I bought my first house, I got an FHA home loan because that was the most popular option at the time. These require 3.5% down right now. The private mortgage insurance rates are very, very low, and most of these are sold on the secondary market as well. We've included a website on here, hud.gov/buying/loans. All the information that you could possibly find on buying your first home going with an FHA home mortgage is on this website. All of our first-time home buyers that we represent, we send to this website. You can get a lot of your questions answered, and there's also online chat websites that you can go onto on this website to get a lot of your questions answered as well. There are 2 0% no money down loan options available on the marketplace right now as well. Like for example, here in Tippecanoe County, where Purdue's located at, there are certain areas of the county that will qualify for a no money down house. You have to be outside of the certain city limits in order for the house to qualify. There are restrictions on your monthly income, your annual income, and things like that, so you'd have to talk with your lender to make sure you'd qualify for that. But you can actually purchase the house with no money down. And after you spoke with your financial advisor and your mortgage lender, if they felt this was a good option for you, this may be something you would qualify for. We also have the website included on here for that as well. And also, if you're a veteran of a war, have served in the military, you can also purchase a home with no money down. This is a great benefit if you've been able to serve our country. And the website on here, the benefits at the va.gov, that website's on there to answer all those questions as well. One thing that we've kind of put together is we found 4 houses in 4 different locations across the country to kind of show you the difference between what the rental rate would be, the difference between what a mortgage payment would be, to kind of give you a snapshot of what the different marketplaces across Lafayette. We found one in Fort Myers, Florida, Washington, D.C., and out in Denver, Colorado. That way you can kind of get a difference, an idea of what the rental rate would be compared to the mortgage payment. So I'm going to get here on the computer while Greg kind of goes through some of this.
Okay, so anybody in here, has anybody bought a home yet? Purchased a home? Everybody's renting right now then, or living in dorms? Okay, the first house that Brett's going to pull up is going to be the one listed here in Lafayette, and it's listed at $132,900, and it's a what we would call a normal transaction in the real estate world, where it is listed by a real estate agent. It is owned by a seller, and obviously a purchaser such as yourself would be the one to come in and purchase this house. It's 3 bedrooms, 2 bathrooms. It's gonna it has a full basement. It's 1,200 square feet, listed at $132,900 on Central Street, which is located near Highland Park in Lafayette. So we'll pull that up here really quick. And like I said, this is considered a regular transaction home. So you'll be able to see this, what type of money in Lafayette will buy for your house. So, and we sold it already, I'm sorry. So if you want it, we already sold it. But that's okay, we can finance it in one day actually. Yeah, sold it in one day. So, computer.
Congratulations.
Thanks. Anyways, so the house is, to go through the buying process with something like this, you would meet with your financial lender. That's normally where we recommend everybody to start with. Then you would work with somebody who is, part of the National Association of Realtors, preferably Brett or I, but anybody that you're comfortable with working with. And you would go through multiple homes. This is the home that you guys decide on. So we would sit down at our office and we would pull up comparable home sales to this property. So homes that have sold in the school district, homes that are comparable in size, bedrooms, if it's got a basement. This house has a 2-car detached garage. It has a screened-in porch. It has a nice deck. It's in a great area, very safe area. So this house was priced right. Like I said, it sold. So once we would come to a mutual agreement on a price, we would negotiate the contract for you, and then from there we would present it to the listing agent, negotiate that, and come to mutual agreement, and then it would be released to your financial lender, and they would be responsible for actually getting the loan to close, and then they would walk you through the steps with that. So with this house, this is what is available, one of the homes that is available in this price range for the 132. So the next home that we're going to talk about is in Fort Myers, Florida, and it's listed at 135. And it's called a short sale. It's listed as a short sale. Does anybody know what a short sale is? Yes.
They're selling it for less than what they owe on their house.
Absolutely. So in order for a homeowner to qualify for a short sale, they have to stop making payments on their mortgage. They have not gone into complete foreclosure status, but the bank is agreeing to take a loss on this home in order to sell the home without actually going into foreclosure status. It still affects your credit score, just like a foreclosure does. This is on your credit report for at least 7 years, and then from there, it would take that long to come up with your report. So once Brett pulls it up here, this is also a 3-bedroom, 2-bath home. Yes.
Sorry to interrupt.
You're fine.
It is the short sale that you're saying. Is that like a good thing for us to go for? Is that a good deal for us, or does it just mean that the person didn't take care of their money?
Most of the time, yes, it can be a very good deal, just like a foreclosure, which we'll talk about here in a second. You are going to spend less money for the same house. This house right here versus its neighbor's house, could be $60,000 price difference. But the downfall to a short sale is that it can take up to a year to close on the property, because when a bank is going to sell a home for less than what is owed on it, they're taking a loss, so they're in no hurry to lose money. So the seller, we can negotiate a contract with the seller, but once the deal is accepted by the seller, then we have to present it to the bank, and then they have a specific person at the bank that works in short sales, and from there, like I said, it could take months and months and months. It could take up to a year. So they are very good deals when they work out. So
one thing that I'd recommend is if you're looking in the marketplace in other parts of the country, is there's qualified short sale agents called CDPE. Our team is a CDPE specialized team. In Lafayette, we can close a short sale property within 45 days. So we've actually gone and been trained to do this. We work with a title company here in Lafayette to actually close these properties. What you'll find is sometimes, for example, some of the homes that we've been able to close here in Lafayette will sell 15 to 20% below market value. So for a first home, if you're willing to wait just a little bit longer and you're willing to maybe do a little bit of paint and carpet, maybe put in some appliances, you can really get a good value on a property. I would just really make sure that you're finding a really well-qualified agent if you're buying in Lafayette, if you're buying somewhere else in the country, because you want to make sure that you're having somebody who's protecting your best interest in buying that house. If you're just looking for somebody who's going to get a paycheck, you're not going to be in a very good position.
Right.
Like for example, on this house here, you can see that it's not horrible shape. It just needs, it has no floor coverings. But this house, I pulled up the county records down in Fort Myers before we came here, and this house sold for $295,000 when it was built new. So for $135,000, it's well below what it sold for when it was new. So it's a good opportunity to get a good value if you're looking for something like that.
Right. Something to put a little elbow grease into. And the CDPE that Brett was talking about is a certified distress property expert. So it is a certification that you get in order to help home buyers such as yourself walk through that process.
So,
So,
for example, the rental rate that we pulled up down in Fort Myers, I searched for several examples down there, if I can find that right sheet. Did I leave it up there, Greg?
I have no idea. Nope.
That's right. So, let me find that real quick. For a comparable 2-bedroom, 2-bath townhome in Fort Myers, Florida, which is a kind of like a carriage house set up in a gated community, you pay $13.95 per month plus electric and $150 a month homeowners association fee. If you purchase this home, if you would qualify and work with a real estate professional, you could buy this on a conventional mortgage for about $885 a month. So the house payment is relatively less in that marketplace if you were to purchase, just for an example on that. Yep.
What's a homeowner association?
A homeowner association fee, like if you live in some communities, like a condo or an apartment or something like that, a homeowners association fee is going to cover things like lawn care, snow removal. Some of them will actually even cover insurance on the structure of the building. For example, if your roof were to go out, they would cover that. And they also do cover general exterior maintenance, like of pools and clubhouses and things like that. If you're looking to buy your first place and you don't want to have to worry about maintenance and things like that, it may be a good thing to look towards if you don't want to have to worry about taking care of the lawn and things like that. And then in terms of having to cover insurance, you would not have to insure your actual structure, so you would just have to get a quality renter's policy for the interior of your property. Yes?
If you make an offer on a first-time house, is there a socially accepted number? Like if the listing is 130 and you want to try to get better,
Mm-hmm.
do they mark it up 10% because they envision people will make a 90% offer?
I would say it's based on the market area that you're in. For example, here in Lafayette, our market is very, very strong. Our real estate group has sold over 100 homes since January 1st, so it's been a very active marketplace here. So homes are generally priced fairly well to sell here. So a home that's listed at 135, I would say a reasonable starting offer would be about 125. Most sellers will pay your closing costs in our marketplace, especially if you're a first-time home buyer. So $125,000 offer would be reasonable. Now, if you're buying outside of our marketplace, I really can't speak to what would be a reasonable expectation there, but a qualified real estate agent in that area should be able to tell you what that is.
right, and I think that the averages would show that most homes in Lafayette sell within 3 to 5% of list price. So, and that could be above or below depending on the situation, if there's multiple offers or anything like that. So,
like for example, that first house we showed you had 3 offers on it within one day.
right.
It was a popular property, so.
Okay. So the next house we're going to talk about is a condo, which we just kind of touched on that for a second. This is in Washington, D.C. And as you
somebody was moving to Washington, D.C., weren't they?
right, so here you go. Well, this is for sale, so maybe we sold you something. But this is a 1-bedroom, 1-bath, 550 square foot condo. So you're at about a third of the space with 1 bedroom and 1 bathroom, and it's also listed at $135,000. So included in that mortgage payment is also, like we had discussed, is going to be, your homeowner's fees, which are going to include the maintenance of the property, because most likely they're going to remove snow, because everybody knows Washington D.C. gets a lot of snow. They're going to maintain the flower beds. They're going to maintain the brick facade on the exterior of the building, that type of stuff. And that's when you would want to talk to your insurance agent about the right insurance coverages on that property. So 1 bedroom, 1 bathroom, 550 square foot unit in Washington D.C. is $135,000.
And it took me a long time to try to find anything in this price range in Washington,
Right.
D.C. It was a difficult task.
So,
but it's a cute little place.
Right.
And in comparison in rent, the rental rates in Washington, D.C. for a apartment building, 450 square foot walking distance to shopping, was $2,250 a month plus electric. So
it's almost $900 more than Florida, and that's about $1,400 more than what it would be to rent something of the same size in Lafayette. The average home, 3-bedroom, 2-bath home in Lafayette runs from the $750 to the $850 area, depending on location and school district. And so,
it's a nice rooftop garden.
So as you can see, location in the country is definitely going to affect the home value of your property. And, if any of you guys watch House Hunters on TLC or whatever, you're going to see that people that are just graduating college are going out and they're buying these $700,000 houses on a brand new salary with a company where they probably make $40,000 to $50,000 a year. Well, in Lafayette, you're not going to qualify for a $700,000 mortgage on something like that. But we also stop at 30-year mortgages. So you have a 30-year repayment plan. And these large metropolises like New York City, Chicago,
Sometimes they'll do
California, 40, 45, 50, all the way up to 60. So if you take that over if you amortize your loan over 60 years at 5% interest rate for $135,000 or whatever, you would be paying astronomical amounts, like probably close to $900,000 for that house. So just keep that in mind as well. So the last house we're going to pull up is a foreclosure. Does everybody know what a foreclosure is? Yes, bank owned. Bank is taking it back from the previous owners, I guess. So this is a 3-bedroom, 1-bath, 870 square foot unit in Denver, Colorado, for $135,000.
Will it only be cheaper if they're foreclosed, or do you expect them to be more expensive?
A foreclosure is definitely going to sell for less than well, I won't say definitely. 90% of the time is going to sell for less than what it would if it was not a foreclosed home, because the bank is trying to recoup all of its losses. It's gone through the foreclosure process, which can take up to 2 years from the time that the people are evicted from the home to the time that it's back on the market with a real estate agent. It can be up to 2 years. So during that time, there's been no maintenance of the property. They're winterized, which means they put antifreeze in the pipes to keep them from freezing in the winter. But other than that, people break in, people cause damage, whatever. So
They generally smell.
Yeah, they generally have musty smell. So they require a lot more work. So banks are aware of that, and so most of the time they will sell for much less than what.
Kind of a common misconception is when you buy a foreclosure, it's just like buying a regular house.
Correct.
You get clean title, you can still have an inspection. It's just like buying a regular property. So there's really, you can still be fully protected. If you find out that the house is sinking 1.5 feet in the back, you don't have to buy it. If you find out that the furnace and the AC unit are not working at all, you don't have to buy it. It's completely fine to still have inspections. You can still get a full normal mortgage on the property. That's not an issue at all. You can still have all those standard contingencies within purchasing a house like that. And then the rental rates were actually not too bad in Denver, Colorado. I was surprised. We're $11.50 a month for a very comparable house what you would get in Lafayette, Indiana. So that's kind of the history on that.
So does anyone have any questions about the different types of homes you can buy, as far as like price sale versus a repo versus a short sale? Anything like that? And your interest rates are going to pretty much remain the same. And something else that, if you see a repossessed home, something that we didn't touch on yet, was that if you see a repossessed home and you see it and you see that it has a lot of potential, but you only have 5% down, and that's going to be your down payment. So where are you going to come up with all of this money? There are loan programs out there that do qualify, that if you do qualify for, that you can build into your mortgage, basically, repairs. There's a 203K loan, there's a home path loan, which is through Fannie Mae and Freddie Mac, and you can actually put the repairs into your mortgage, so you are getting a home that is livable, but you are going to pay for that in your mortgage. So.
And then if you are interested in actually looking at all available foreclosure homes online, all 3 of the main foreclosure websites are listed right on the very front of your package here. HUDHomestore.com is all government-owned foreclosures. HomePath.com.
Sorry.
Okay, and then HomePath and HomeSteps are just 2 different variations of foreclosed properties owned by the government as well. Then you have a plethora of local bank foreclosures, and you just kind of Google and you'll find those online. Okay.
Okay, my question is just kind of out of curiosity, but how long should you plan on living somewhere before you consider buying a home? Like, I realize, most of us might get moved around, so, I mean, I realize buying a home is a huge investment, and, sometimes they're hard to sell, so. Is there a standard? I mean, I know it's not a standard number, but.
I would say base it on the local market where you're going to be at. Like in Lafayette, I always tell people the rule of thumb is if you plan on being here 2 to 5 years, it's a safe investment, because you should be able to recoup the cost on what you're going to invest in, because Lafayette's a very stable market. We haven't really seen any decline in market values, but if you're going to move to an area of the country, they've seen an annual depreciation on home values, it probably is not a wise investment. But if you're going to move to an area of the country where they've remained stable over the last 2 to 5 years, then you probably should be okay. When you go in to apply for a home mortgage, they actually look at college as your job. So when you go and get your full-time employment after college, they'll ask, they're going to require, normally it's 60 days to 90 days worth of pay stubs. after you get that full-time employment. So you should be able to qualify for a home mortgage based on your, your income, based on your credit history and things like that. So you should, based on your financial status and things like that, be able to qualify for a home mortgage. But it's really depending on how long you're going to stay in that area.
Are there any type of like rent-to-own programs or?
There are. It's a case-by-case basis. A lot of times what you'll find is if you qualify for a mortgage, it's a better scenario to actually purchase the home because there's more tax benefits and things like that. You're giving more benefits to the actual owner of the property if you do a rent-to-own than if you actually purchase. Because all the interest that you pay on your actual mortgage is 100% tax deductible. We're going to get into a couple of the Indiana housing things that are available here in a second. But I would say that if you could qualify for the mortgage, there's much more benefits to purchasing than doing a rent-to-own. Because, for example, let's say that you do a rental contract and for some reason you decide that you don't want to fulfill that contract, all the initial investment that you have in that you're gonna lose, and then they can also come back after you for the default portion. As to where if you own the home, you could sell the property and you don't lose anything into that.
Thank you.
You're welcome.
So what are the advantages compared to renting to buying?
Okay. If you rent, basically you're just paying somebody else the money that you have, and they're basically maintaining the property for you. If you're only going to be in an area for a very short amount of time, I would definitely rent. There's basically no risk in renting because somebody else is maintaining your property for you. If you're going to be in an area for, you feel comfortable knowing that you're going to be in an area for a while, and you're okay maintaining that property, you're okay investing your money into that, you feel comfortable with the financial status that you're in, and you can obtain a mortgage, I would recommend at least looking into it. As long as you feel comfortable knowing that you're going to put some money into it and that you're going to have to maintain that property, because things always come up when you own a house. Your air conditioner could go out, your furnace could go out. Things that we always recommend when we represent first-time home buyers is have your real estate agent negotiate a one-time home warranty for you. That way everything in that house is protected for you for at least a 1 or 2 year period. So if you live there 6 months later, your air conditioner junks out in July and it's 100 degrees outside, you call that warranty company and you get a new air conditioner, or at least it's repaired. Most sellers are willing to do not everything, but just about everything to get their house sold, so they'll most likely pay $350 to protect you for a year. Okay. Yeah. Let's see what we got next. One thing I wanted to touch on is that most of the federal tax incentives are gone. There's really nothing left. But the state of Indiana really has a great program still available if you stay within the state of Indiana. It's called the Information on the Indiana Housing and Development. This is a straight tax rebate initiative that's been out for about 6 months. The website, I think Greg put it up on there. Basically is what this is the interest that you pay on your mortgage is tax deductible. But this program actually, they send you a refund check back. So essentially, let's say you pay $1,000, which is a low number, in interest on your mortgage every year. You would actually get 30% back of that in the form of a refund check for 30 years of your mortgage value. So for every year that you would have that mortgage, the state of Indiana would send you a check every year for the life of the loan that you actually own that. So it's a really good program, because most of the time you're going to pay a couple, $2,000, $3,000, $4,000 worth of interest every year on that mortgage. So it's basically free money the state of Indiana is giving you, and it's an initiative for people to stay in the state of Indiana, to live here, work here, buy homes here.
Is that something you need to ask your realtor about, or do they tell you about it?
Your mortgage lender is the one that has to set you up with it. Most real estate agents should remind the consumer and remind the lender to do it. Not every lender is willing to do it, but most in our area, I think, they'd be willing to do it because it's free money, so you might as well take advantage of it. There are additional grants available based on income. For example, I was a part of a really great project here in the city of Lafayette that gave 20 grant projects available for brand new construction homes. It was $11,000 grant for down payment and closing costs. So we were able, and we had probably 10 grad students that bought these homes. And the city of Lafayette granted the money. You had to live in the home for 5 years. You didn't have to put any down payment down. No property taxes for 5 years, as long as you agreed to live in the home for 5 years. And then after 5 years, it was totally abated. You never had to pay any of the money back. So definitely, wherever you move, ask your real estate agent, is there any local, state funds available for down payment? Because there could be possibly. A City of Lafayette's getting ready to redevelop a new project here in Lafayette that could be available with some down payment assistance. And most of the time, the restrictions aren't that great. I mean, it's $40,000, $50,000, $60,000 income limitations, which, you know, there are quite a few people that apply for that. So definitely check in with your agent on that. Greg kind of already touched on the buying process. We included in here some mortgage payment and rental rate options. That just kind of gives you a snapshot of kind of the different payment options. You know, for a $125,000 home, if you had about $4,000 to $5,000, you could buy a property. Most of the time, the seller is going to pay your closing cost, so that's really nothing that you would need to worry about unless the seller wasn't willing to. And your house payment would really range about $800 to $850. That would include your taxes, your mortgage insurance, and also your property insurance on the property as well, which is a pretty reasonable rate considering that your rental rate would be a little bit more than that.
Yes.
I've been doing a lot of property hunting lately for where I'm moving to, and I'm mostly looking at rentals, but I've seen a whole lot of Section 8 accepted, and I have no idea what Section 8 is.
Section 8 is a government-run program. It's basically a voucher system. If you Google it, you'll probably get a little bit more information. I don't have a ton of knowledge of it, but it's basically, it's a government program. It's like a housing initiative, basically, is what it is.
Is there anywhere you could find out where, like, if the area is actually safe?
You can usually go to the Chamber of Commerce for about every city, and they'll give you crime statistics and things like that. And usually if you go to your local police department, they have access to all the local crime statistics as well.
If you're looking to go from renting to buying, is there like a period of time that you should like give yourself, like start X month out and then end your lease or something?
Normally during the buying process, we always encourage our buyers to give about 3 months. Normally it'll take about a month to month and a half to find a property, and if you give yourself about 45 days to close, 60 days max, that's usually a good amount of time. So if you have, let's say, 6 months left on your lease and you start looking online, you find a real estate professional, get yourself pre-qualified, that should be about enough time, I would say.
All right, anything else you want to talk about? Nope, I think that's it.
All of our contact information is on there too. You're always welcome to call us, text us, shoot us an email, anything you want.
Us, whatever.
Yeah, we're on Facebook all the time, so you can always catch us on there too. So,
thank you.
Thanks a lot.
Okay, so all of our speakers are still here, so if you have any last minute questions, now might be the time to ask those. Make sure you all fill out the surveys that you should have picked up as you came in. That'll help us in December and next May make this program even better. And you can, and if you can just give that to me or one of these lovely ladies over here, that would be great. So you have all your handouts and everything, and I think the last thing before we stop is the drawing for the $25 gift card, and the winner is Ashley Frake. Is that correct? Oh no, she left. Randy. Okay, well someone else is gonna get to win. All right. Does anyone have any questions? Something like that? Okay, thanks. Like you said, turn in the survey. Enjoy your free gifts that you got this evening, and say hello to some of our presenters.